Hello. Hello, and a very warm welcome to everybody. It is my sheer pleasure and privilege to be welcoming you all to the Live Mint special series on future of wealth creation in partnership with Nippon India Mutual Fund. It's very important to give you some context to the conversation here. We began with a very impactful piece in the Mint, really establishing the context of what we're trying to do here. Analyzing the changing dynamics of personal finance has never been more crucial or testing as it has been in the COVID 19 era. In view of the Monetary Policy Committee's decision to lower the interest rates, it is perhaps pertinent to understand the impact on long term wealth creation. As part of our discussion on future of long term wealth creation, we have a very meaningful panel here, essentially trying to decode and understand strategies adopted by high net worth individuals and institutional investors to create and preserve wealth amid the pandemic. Please help me welcome Saugata Bhattacharya, Executive Vice President and Chief Economist at the Axis Bank. I also have with me Sanjeev Taparia, Managing Director of Famicare Limited. Sanjeev Taparia's family sold the family business of Famicare to Mylan Labs at $800 million in 2015, and he has been an entrepreneur with a successful track record and is now running a family office. Also, please help me welcome Bharat Parikh, who heads the product and segment private wealth at ICICI Securities. I also have with me Amit Tripathi, who is the Chief Investment Officer, debt at Nippon India Mutual Fund. Gentlemen, thank you for talking to me. It's a sheer pleasure and privilege to be hosting you at the Live Mint special Future of Wealth Creation. Thank you for putting your time and energy to this. I think my first conversation with all of you, the live conversation on this topic, I know we have all spoken for the print piece, we've established the context. But I think it's really important to get a broad macro view, and I think it's very sort of prudent to begin with an economist view on this. So, Gautam, my first question to you really is that these unprecedented times, in almost every conversation in the newsroom, risk and perhaps understanding of risk and mitigation of risk clearly is at the heart of all conversations. I want to understand from you that if you were to give me a broad sense or macro view on where we are on the economic front, what would you really sort of advise one, and how would you want to look at risk now?
So first, Shrija, thank you so much for having me on this panel. I mean, what a privilege to be on a panel like this. Thank you so much. By now, I mean, we have all heard about the unprecedented tag to the current crisis. But let me just give you some quick facts to give you a perspective of just how different and unusual this current crisis is, the blackest of the black swans. First, IMF expects global GDP to contract about 5% in 2020. For perspective, the year following the global financial crisis 2009, global GDP had contracted minus 0.07. Two, everybody has heard about the intervention by the global central banks, the massive QEs that have been rolled out. The balance sheets of the three major central banks, the Fed, ECB, and the Bank of Japan, expanded from about $4 trillion in 2008 to about $14 trillion by February 2020. Now, as of end July, early August, it's now about 22 trillion. So the first expansion was about 12 years, from 14 to 22 trillion in 5 months. Three, the S&P today will probably will show the fastest recovery from a bear market, which is defined as minus 20% drop at one point in time, in 160 days. That's about 5 months. The previous shortest recovery was 1982, which was 8 months. Yeah, the GFC 2009 was about 5 years to come up to this from the 20% drop levels. The yield on 10-year US Treasuries, which is the benchmark interest rate, is 0.67. While the 10-year US TIPS, which is the inflation indexed security that they have, is for 10-year TIPS bonds is 1.67, 0.67 versus 1.67. For a market as deep, large, and liquid as the US, that's a massive difference. So just to give you, there are many other facts like this, the US unemployment rate, etc. Coming to India, we expect the GDP will contract by about anywhere between minus 6%, minus 10%, and probably beyond. I mean, we don't know. Depends on how the lockdowns, etc., progress beyond this. So in nominal terms, our income loss, nominal GDP, income loss will be about 20 to 30 lakh crores. 20 to 30 lakh crores out of a GDP of about
Yeah.
210 lakh crores. That's a huge drop, huge change, and enough to cause large behavioral changes. Recovery is likely to be very prolonged, slow. Consumers are deleveraging, capacity utilization levels are low, risk aversion levels are very high across the board. So let me stop here. That's a relatively bleak outlook on the system, but there are many positive, which I'll come to later. Thank you.
That was sort of very meaningfully laid out by Saugata. And if I were to sort of catch on what he said, that risk aversion is extremely high. I sort of want to bring you in, Sanjeev, here that, you have created a business grounds up, you sold it, now you're in the wealth allocation mode. One would really want to understand from you that, how are you thinking about wealth allocation at times like this? If I were to just go around the pointers, what Saugata mentioned, that the pointers look pretty bleak, what he sort of just pointed out. So clearly, predictability, safety, assurance are playing out in the minds of investors. Are they? Give us some clarity there.
So thank you so much, Shrija, for having us in this talk show. And you mentioned about predictability and visibility. Frankly, I wouldn't say that we've reached a stage where we can be clear about visibility or predict much from where we stand today. And hence, I would say safety is what we can focus on. There are no easy choices in asset allocation currently. We've got a great run in the family that we had in investing in debt markets for the last 4 or 5 years. But the yields have come down significantly. And I would say today investing in safe debt should be seen as preservation of capital, which is also important at such times. Equities, on the other hand, remain important for growing wealth, but it's no longer an index play. I think you've got to be very clear about the sector, the stocks that you want to invest in. So it still remains a very interesting area to increase your wealth or wealth creation. But I think you need to take a long-term view on either of the assets that you put in. One of the interesting ones that we are actually looking at, other than equity and debt, which are the general ones that people look at, are the alternative investment opportunities like real estate investment trusts that are there, InvITs that are there. The recent one of the Mindspace REIT that came in, we found that very interesting with an
Sure.
expected post-tax return of 7.2%. We felt that that's an area that people can look at for investing and allocating some of their assets. There is some occupancy risk in the current times, but if you look at the scope of appreciation of the capital asset as well as the rentals, which can give us an additional kicker, we felt that this could be an interesting allocation to be putting some money in. So that's the broad outlook, I would say, with how we are looking at this.
Okay. So what I come to you, sort of what Sir Sanjeev just mentioned, that, he also mentioned that investing in safe debt, looks to be something on top of the minds of investors, but that is very much linked to the interest rate scenarios, really. And I think that is where sort of your view comes in, very important that, what really is your outlook, if you will, on the interest rates, both from the short term, medium term, or long term perspective. One is getting a sense that, FD rates are declining continuously. So, give us some clarity or sense there.
No, so it's a great segue. So for interest rates, in short, lower for longer. So that's one thing that we know. India, globally, everywhere. Uh, I think Reserve Bank is likely to keep the repo rate, which is remember that interest rates is a very broad range. I mean, there are hundreds and hundreds of rates. So starting from the overnight, the basic policy rate, Reserve Bank is likely to keep the repo rate at 4% for a long period of time. We do not expect any normalization, taking the rates back till way out into 2021, maybe Q4 of 2021. The rates that will probably begin to change at that point will not be the repo rate; it will be the reverse repo rate. Yeah. So, in terms of moving, I mean, everybody, I mean, all your listeners will now know have learned about the steepness of the yield curve. I mean, so on the bottom end, I mean, the T bills, 3 month T bills are getting raised at below sometimes the reverse repo rate. On the other hand, I mean, the spread on the 10-year, it's 10-year government security. So that has actually, I mean, the spread is about 185 odd basis points, which is usually, I mean, in terms of norms, it's quite large. Then on top of that, of course, I mean that's because of the concerns on additional borrowings. I mean, concern on the fisc, additional paper borrowings, etc. What might come in. Now there is also a need to differentiate between bonds and credit. So it's typically, I mean, when we talk of bonds, I mean it's that risk-free asset, and it's actually not very risk-free now. But I mean, on the credit side, the situation is even worse. So because of all the aggressive RBI actions, I mean the enormous liquidity that has come into the system, 3 month paper for a double A company, I'm sure my fellow panelists will know much better on this. 3 month paper is now getting raised at 350, 360, 370, depending on the company. 3 year paper by a similar company, double A company, etc. I mean, people are finding it difficult to sell the paper for at 65, 675. People want higher yields. So, I mean, that credit spread, you remember we talked about risk aversion. So even that is relatively high. Now, what are the things that, what are the policy measures that the Reserve Bank and the government put in place? Reserve Bank's monetization of government debt, etc. So all of that will now begin to play a role in where interest rates go. So I'm talking about the medium and the long tenor interest rates, but the shorter is, I think we know that it's going to be. One last thing, in terms of not just rates, but a very key factor in determining rates will be liquidity. How the Reserve Bank takes liquidity out of the system will be very, very important. The communication that they have to do, because this has the potential of creating very large financial market volatility and instability once the extraction of liquidity process starts.
Yeah, that's sort of helpful. Amit, I come to you now. We just sort of heard from Saugata, and he said that in the short term, clearly it is on the decline, the interest rates. And he mentioned that in the medium term and long term, much is dependent on RBI's intervention and how we manage our liquidity scenario. These are very sort of meaningful and fair points. Amit, as the architect of, product at a established fund management house, I want to understand from you that how do you escalate the market feedback back into the product? What is the sense you're getting from market participants now? As an HNI, Sanjeev himself mentioned that safe debt seems to be really what on the top of the mind recall there. So what the kind of thinking that you are seeing in the market right now in the safe debt space?
Yeah, so I'll. So first of all, thanks for having me here. Good evening. I'll take a lot of clues from what my predecessors have already spoken about. So I'll rest my case on three broader points. The first point is the uncertainty element, right? So as an investor, the first uncertainty is my own cash flows, my own wealth generation, income earning capabilities going forward. Whether I am a salaried person, I am a businessman, I am an HNI, etc., etc. That's the first level of uncertainty. The second level of uncertainty is the entire macro environment that Saugata so well articulated, whether it is global, whether it is local, whether it is government, or whether it is the RBI actions, etc., etc. So there is that second level of macro uncertainty on growth, inflation, etc. The third level of uncertainty is on balance sheets, which is corporate balance sheets, individual balance sheets, the so-called credit risk that we are talking about. So if I, as a fund manager, I am seeking feedback from investors, these are the three feedbacks that we are getting. These are the three uncertainties out there, and how do we solve for this? And whenever we are looking at products, we are actually trying to solve for these three uncertainties to start with. Added to that, there are two other factors. The first factor is that since the entire world wants so-called risk-free returns today, risk-free returns are not available, right? So as Hogata mentioned, the RBI repo rate is at 3/4. If a double A corporate borrows for 3 months, the whole world is willing to lend to them at 3.5. Am I as an investor seeking returns of 3.5% today? Perhaps not. So what do I seek? I can seek two types of risks here, because without risk, there is no return here. And most of the investors today are erring or willing to err on the side of tenor risk as compared to credit risk. What I basically mean by that is that most of the investor feedback is that, okay, fine, instead of investing for 3 months, I can invest for 2 years. Am I going to get an adequate spread for that? Okay. So that's the second input when we are designing portfolios. The third input is, fine, I caught this spread today. How do I ensure that I preserve this spread going forward? As in, can you come up with products and strategies and implement it across portfolios, which not only capture some of these additional returns without taking commensurate credit risk, but at the same time also ensure that I am able to sustain this additional return that I am trying to lock in the first place. So these are the three input buckets, right? First is the uncertainty to be built in. Second is the need for carry, which is very difficult and not available today, and hence you have to either sacrifice on the tenor or on the credit, and most investors want to sacrifice on the tenor side. And third, how do I gain more visibility that once I am trying to capture these returns will be available to me over my holding period of investments. So if I were to put these three things together, that is where most of the products are, or most of the investors are looking at solutions from portfolio managers such as us. And that is where we are trying to devise more and more strategies which will capture some of these potential returns, and yet, most importantly, give that higher degree of visibility and predictability over a holding period to the investor. So that's the backdrop with which the fixed income industry is opening today. Uh, for example, one of the examples that I can tell you is this entire strategy that is being employed by various fund managers, where they are buying into a 2 to 3 year maturity paper, and for example, allowing it to roll down in terms of maturity. So what it does is it captures the 2 to 3 year spread to start with. By allowing it to roll down, you are ensuring that over a period of time, the duration risk on the asset is coming down. So these are some of the strategies that people are implementing in order to capture the spread and yet reduce the risk of visibility and increase predictability over the medium term as far as the investor is concerned.
Thank you, Amit. That was very, very meaningful, and I think Amit sort of pretty beautifully sort of laid out, the three levers on which they're thinking about devising products in the fixed income, universe. Very clearly, sort of, he said that the risk return and the risk-free return, there's nothing called that. That they want to demystify that myth. He also mentioned very clearly that roll down strategy is a good innovative response to what he's seeing in the safe debt space. I want to come to you now, Bharat. What really are the strategies or ideas that you are seeing which are seeing increasing traction from market participants, and why so? Give us a sense and clarity there.
Yeah. Yeah. First of all, thank you for having me here. And and as my panelists have already spoke, see, right now the situation where we are is that if you look at broadly, markets have recovered most of the losses. So we are broadly, hardly less than 10% lower from our peaks. Uh, Interest rates have already fallen to a level, whereas as his panelist said, that we may not see a much scope in terms of any further drop in the rates. And the fact is that there are very limited avenues available in terms of providing you a return which is more risk-free or perceived risk-free in a current context. And that's where it is important what we have seen over a period of last 3 to 6 months now is guys are slowly and gradually realizing is that markets and returns are not determined by pure play with a one particular asset class or one particular asset, and a particular asset can easily become a quite risky when we are having large allocation. So just to give you a simple thing, that if you just pick up a current investments into a fixed income and you end up buying a long term duration, and if interest rate rises by say 100 to 200 basis point or 1 to 2% over a period of next 2 to 3 years, what you will look at is that close to nothing in terms of your return, whereas you might have thought of investing in a debt for a 3 years or a 4 years time horizon to generate a return. So it's all about a right asset allocation is what we see as a trend, a right strategy adopted, okay, which is fitted based on the client's risk appetite, client's ability to withstand the volatility, and broadly dividing his portfolio into a PCA framework. The way we use it is called preservation, core allocation, and alpha generation. and the ability of an investor to figure it out at what time, what portion of his wealth should be in different strategy. And all three strategies have a very, very important role to play. Okay. Recently, or for last 1.5 years, we have also realized that gold, which was not part of asset allocation or not having any mind share in terms of investments, is slowly and gradually coming back and is actually taken up a center stage over last 6 to 8 months, ever since we had a COVID. So the reason for that has been very clearly, and the way Bogota Dada said, is that all is about that if you know that is the rate of interest is going to be lower, okay, or close to zero over a prolonged period of time, and there is a very limited interest rate or an interest return available for a risk-free return globally. Fact that there are multiple levers in terms of the fact that the liquidity is so high, and your the amount of money printed, as he said, from $4 trillion to $22 trillion now. Now, with that kind of liquidity, even a stability in the portfolio becomes very, very important. And we have seen that gold was perceived to be a very good store of value. Okay, and with a close to zero interest rate or negative real interest rate, it's very important part of your portfolio allocation now, and we are looking at the fact that this is becoming a quite center stage in terms of your portfolio allocation. With the interest rate where we are, to reduce the volatility of your portfolio, guys have realized that it's not debt and equity, it's debt, equity, and gold, or you can say debt, equity, and commodity, which is going to do it. So it's all about asset allocation, your ability to change the portfolio composition based on the market dynamics, and looking at what's really happening in the economy. What are you expecting over a period of next 3, 5, 10 years, and how we are really going to create what you call a risk adjusted return, which is superior to the return which you are expected to. It's all about that asset allocation, and that plays a very, very important role, a center role in terms of bringing the stability to your portfolio. A risk free return, there's not that, there's no free lunches in the world, there's no risk, then there's no return. So as Amit already mentioned, so it's all about making a right asset allocation, bringing the stability required, giving you ability to withstand the pressure and of the volatility and the shocks which is coming to your way, and then navigate through that and find a solution which can really make you generate a reasonable return over a longer period of time. That's
Yeah,
the
so
what
I
we.
think yeah, that was sort of helpful, Bharat. And I think you sort of like categorically mentioned there are no free lunches in the world. But you also said that debt is playing a huge role in portfolio allocation, as you're seeing right now. And that really brings me to Sanjeev. Now, Sanjeev, in terms of somebody who is really a seasoned investor, and how would you sort of look at, going around investing via debt instruments? Of course, one is also referring to this entire unraveling of the INFS episode, which has had significant lessons for all investors of all kinds, right? So I want to understand from you that as a response to your debt instruments, have roll down strategies really worked for you in particular? So when you sort of traverse the universe of debt, what really has worked for you, and how is an investor like you approaching that?
So, Shrija, I think I would want to start with saying that all the investments that we did in our debt portfolio for the last about 4 to 5 years have given us a great return. So, obviously, debt instruments, because of the yields coming down, have been very interesting for all the investors. But it's also taught us some things in this journey. I mean, you mentioned about the ILFS fiasco, and probably I would want to share here that we were also one of those who got hit in a small way. We kind of had invested in the preference shares of ILFS, and obviously we know that, I mean, things just went into a complete south direction, and ILFS went into a default zone. So what did we learn through this journey? I think two things. One is that for an extra kicker that we tried to probably get out of investing in the preference shares, we realized that it's not worth losing the entire capital, because we landed up losing the entire capital in that case. So if you're into debt and you want to kind of look at preservation and safe returns, I think you got to be careful not trying to maximize or try and get that extra 1 to 1.5% returns that you try and make when people come to you and offer you these kind of instruments. The other thing that I would say is that we also had some experiences a year back with the FMPs that were investing into products like Z, LAS that was done, and we were also a part of that. There were some learnings there. While we've come out of that clean with no hits over there, but I think we realized that credit paper and all of these instruments that are there in the market have to be very carefully seen. And as a group, we felt that if we are looking at debt, let's make our portfolio into something which is very safe. So we invested into GSEC, state development loans. This provided us full safety and also actually got us a great return in the last year and a half. As you know, fortunately, I mean, interest rates have gone down and have created great returns for people who invested into that. One of the instruments that we were talking about, a roll down strategy, we were fortunate to kind of look at that asset opportunity last year. It was the Laksh Nivesh fund, which I think was offered to us with a 25-year GSEC paper roll down strategy. From what we invested last year, and we took a reasonably good call to put an allocation, reasonable allocation of money in that, we've kind of got close to a 16% annual return based on the interest rates going down and being a very long-term paper that we invested in. So I think debt, if you ask me, remains an interesting area in terms of the returns that have come. Going forward from here, are we going to get those kind of returns? No. But I think it still remains a spot where you got to invest in for preservation of the wealth that you want to categorize that and put that into your debt portfolio.
That was sort of very helpful, and I think the way Sanjeev sort of took us through his mistakes or learnings and where sort of he actually made significant gains also, and very candidly put. And I think he sort of very sort of specifically also mentioned about the fact that he invested in GSECs and also the roll down strategy has worked really well for him. I sort of come to you now, Amit, that you're somebody who really spoke about the Nivesh Lakshya or the roll down strategy, which has really worked for investors like Sanjeev also. And he mentioned that, long-term investment, 25-year, GSEC paper, that sort of has really worked for him. I want to understand from you that, are there any global comparables for a product like this? How did you think of something like this? And, if you were to go back in time, would you like to do something to revise that strategy, if at all?
So honestly, while there are no strict global comparisons, obviously people have devised various products to address risk management over a period of time. So you have this concept. If I were to very loosely borrow from that, there is this concept of target return funds, where you actually change your asset allocation over a period of time to achieve a particular objective that the investor has, and you bring down the risk in the portfolio over a period of time. So if you were to actually draw that kind of an analogy, while we are obviously strictly talking about a pure fixed income product here, the analogy is the same, that over a period of time, how do you improve predictability, how do you improve visibility, and how do you bring down risk from a holding period return perspective as far as the investor is concerned. To that extent, this so-called so talked about nowadays, the roll down thing does appeal to a lot of investors. Not that there are not other strategies, and other strategies have worked very fine. For example, Sanjeev did mention about the fact that I know that they have invested in your GSEC funds, and a lot of people don't appreciate the fact that if you look at very long time horizons of 10, 15, 20 years, a 3 to 5 year rolling return of a pure play GSEC fund also is in the vicinity of 7 to 9%, which is very, very decent in the context of both historical interest rates as well as current interest rates. And mind you, this takes zero credit risk. The problem with some of these products or some of these strategies like roll down or any other strategy is that while it does ensure predictability and visibility over a period of time, defining that time is very, very important. So I'll just borrow from something that Sanjeev mentioned about generating 16% returns from a Nivesh Lakshya kind of product, or any long duration product for that matter, in the last 1 year when interest rates fell precipitously, will not get repeated every year. But what a Nivesh Lakshya will do is that over a period of 5, 7, 10, 15 years, it will allow you to preserve a lot of these returns that you generate over a period of time by employing the strategy that it employs. So you are improving visibility as long as you are sticking to a required time horizon in each product, whether it is a plain vanilla product with a normal duration strategy, a roll down strategy, or any other strategy for that matter. So, I think in all this that we discuss, what is very critical from an investor standpoint to understand is A, there is no free lunch. So, you take some risk when you start in a product, whether it is duration risk or credit risk. B, you minimize your risks by marrying yourself to a proper time horizon of investment so that you are cutting out any interim volatility that is possible in these products, because all these are at the end of the day marketing products. So as long as the investor is disciplined, some of these fund strategies that I am talking about and that Sanjeev so well alluded to can actually improve predictability and visibility around returns as far as investors are concerned. So we would strongly recommend that with the required discipline in terms of the holding period, wherein the investor has to stay in these products for a reasonable period of time.
So I think you are sort of doubling down on this aspect of duration. I sort of want to sort of bring you in, Sanjeev, before I sort of get on to Bharat here. So Sanjeev's risk appetite is of course higher. He has amassed huge entrepreneurial wealth. What about a person like me, for sure? Like, somebody who is salaried, somebody who likes predictability of returns. Are these products sort of also, relevant for people like us? I mean, Sanjeev is an HNI category. So how would you define that kind of asset allocation, for a different category of investors you're talking about? Absolutely here.
So it's,
Shrija, that's for me.
Yes, Sanjeev. I mean, how would you, if you were to advise, somebody's a non-HNI salaried, how would you approach, investment then?
So honestly, Shrija, I think things are tough in terms of choices right now. I mean, it's been said that equity markets have actually gone up significantly from how they were some time back looking at the COVID crisis. They seem to be something which are fairly valued today. Debt has actually now reached a stage where it's going to be not very easy to, I mean, even look at returns because inflation is there. The yields have come down. Are we looking at any other kind of opportunities like real estate? Not the right times. So where do we look at for, as you said, investors right now? Even if I have to give a view, I would say that playing it safe is going to be the right way to do it. And most of these retail investors would look at long-term view. They're not looking at investing and getting out. So in the current volatility, if you are able to invest in safer products where you're sure that you're not playing with the credit risk, is I think the way to go forward. And as I think Amit had suggested, that if you take a long-term view and a long-term horizon, these products would give you a reasonable return and would be probably something that would also provide enough safety that is required in today's time.
Okay. Bharat, would you want to add to that? I think, I'm hearing, 4 or 5 keywords playing out this entire conversations: volatility, safety, predictability, long-term investment return, and perhaps what Saugata is sort of really started the conversation with, understanding of risk much better. It's very important right now. So, we wanted to add to what sort of, Amit and Sanjeev just sort of clearly laid out right now. So where do we go from here in terms of how we are thinking about asset allocation in these times?
right. So let me just spend maybe few minutes on, or maybe a small time set in terms of on the fixed income opportunities, right? So broadly, as you asked a question that where do a retail guy invest and where do HNI guy invest? See, ultimately, it's your risk appetite, right? A guy which has a higher risk appetite will probably take a higher risk and maybe invest into something where he can generate additional return. But ultimately, today, fixed income is basically for wealth preservation, and everyone is looking at the fact that how can I really invest my money and preserve my wealth. So the role of fixed income is now more towards a wealth preservation. Another important thing is it's all about to figure out what time horizon you want. So example, the roll down strategy which we picked up, Now today market has evolved over a period of last 3 years. So if you just take a roll down strategy, and where's what Amit mentioned is about providing a predictable return. It means that today I'm investing. Today I know what is the rate of interest for 3 years. I'm investing into a product which is 3 years. I know what is broadly what return I will get at the end of 3 years. Interim volatility is part and parcel of the life. Nothing will change. But I broadly know that end of the 3 years, my 100 rupees will become, say, I'm going to get a 6% return, will be like, say, 119 bucks. So I broadly understand that what my return will be maybe 3 years down the line. But interim, the returns will be much. So it's all about figuring out what is the time horizon and what is the purpose of the portion of the wealth which you're putting. So that is all about wealth preservation. You are looking a short-term goal, pick up a 3-year roll down strategy. If you are looking for a 10-year, you can have a 10-year roll down strategy. And as Sanjeev mentioned, if you are just really looking for a long-term investments, you go and pick up a Lakshya. So it's all about figuring out the right time horizon in terms of even building your fixed income portfolio. There are multiple assets available in fixed income over and above pure roll down strategy. When if you believe the interest rates are going higher, you pick up an ultra short term fund which will be able to protect you from the rising interest rate scenario. And at the same time, if you believe that interest rates are going to fall down, you go and pick up a GSEC fund or long duration fund to optimize on the interest rate. So it's all about a time horizon, your ability to figure it out what really you want from that set of money which you have. And as that is for the wealth preservation, how can I make sure that I generate a return which is higher than inflation and preserve the value of my money in broad sense and provide me the stability. And then the second big question comes that, okay, I've allocated an X amount of money, and so what should be my debt, what should be my equity, what should be my gold, and what should be my any other alternative investment. The way Sanjeev mentioned, why don't we look at invades, rates, and other alternative assets, maybe commercial real estate, because they're all provide you a quasi risk adjusted return of some rentals, some dividends, and all those things. So it's all about creating a portfolio, looking at the correlation of the portfolio. So example, you're looking at a long time horizon, look at a 3-year rolling return portfolio and look at the correlation between multiple assets over a longer period of 15-20 years and find an optimal portfolio. The way we call it is efficient frontier of your risk profiling. So based on your risk, your time horizon, your appetite to build in, you figure it out. Okay, I want this, how much drawdown I'm ready to take, what have been drawdown to this kind of a portfolio in the past. If I look at Monte Carlo simulation and figure it out that how much money I can lose over a period of time, if I follow this strategy, what is the probability that I will have a negative return over a period of 3 years? And when you have those data points and you just put it together, maybe a 5 or 6 scenario, and then you can say, okay, I don't want 12% return, I don't want 5% return, let me go for this. This will generate mostly 8% return to me. I may have a drawdown of say 10%. I may have a risk of say 3% on my return. My volatility will be say 8, will be mostly 6 to 9 or 6 to 10. So it's all about making yourself comfortable. It's portfolio, whether it is retail or HNI, is all about investment is used as a second source of income, right? So you broadly want to make sure that you create a portfolio where you can sleep peacefully. It's all about not taking the risk. It's about sleeping with the risk. If you can sleep with that risk comfortably, you're not bothered what is happening in the world. It doesn't make a difference. I'm 3 to 5 years, my time horizon. I'm not going to lose money. I'm very confident. I think that's the right asset allocation. So there's no hard one stereotype answer that 60-40, 40-60 is the answer.
So it's not about investing with the risk, it's about sleeping with the risk, as you put it.
Yes. It's all about the risk you can sleep with.
Okay, so my larger question really to the panel, I think we spoke about quite a few things here. We spoke about, how to understand risk in this scenario. We spoke about the outlook on interest rates. We spoke about how to pursue the debt strategy. We spoke about, how do you think about innovative ideas like, roll down strategy. We spoke about the fact that, how debt is playing a crucial role in the wealth preservation during these times. We spoke about the fact that asset allocation is the key in devising all personal finance strategy, be it a salary person like me, be it a person who's an HNI like Sanjeev. I want to sort of understand from this meaningful panel here that we're on the topic of future of wealth creation here. And really not getting into the tech side or the robo-advisory side here, which really would sort of take up jobs of everybody sitting on this panel here in all the various fields that we're doing right now, be it journalism, economics, fund management, Perhaps Sanjeev is the safest tip because amassed total absolute wealth for himself here, sort of leaving him aside because he's investing in those startups to fuel the entrepreneurial wealth. I want to understand from you that, if each one of you to give me two concluding remarks, and, where do we go from here from a strategy perspective on future of wealth creation, what would that be? I could sort of begin with you, Saugata. If you were to have, perhaps, on this panel, you have a fund manager, you have somebody who devises product, and you have somebody who's an investor. If you were to have maybe two things or words of caution or two words of advice for them, what would that really be in this larger ambit of future of wealth creation?
Um, so again, far be it from me to advise the fund managers. That's not done. Nobody will listen to an economist anyway. Incidentally, you talked about robo advisories. I can assure you that in 5 years' time, Saugata the economist is a extinct animal. There's no way that I'll be able to compete with the machine that can process 1 million outcomes a second. It's the future is very much on the wall. The writing is on the wall. In terms of the what two trends that I think are going to be important for wealth creation now, not preservation, now going forward into creation. One, of course, is customization. You are the expert on fintech, although you said you don't want fintech. But this entire digitalization and deluge of data that is likely to be a key outcome of this crisis, and acceleration of this trend. This will enable customization, and enable massive innovation in financial products. The ability to match needs, products, etc. That's one trend that is likely to happen. The second trend is post-COVID, again, an acceleration of the process. There will be a clear set of winners and losers in the market. And this is from an equity perspective. This is not just from a credit and debt perspective, from an equity perspective. I think the ability to spot the winners, there are so many changes that are now taking place and will accelerate over a period of time. The sectors, the companies which are more agile and resilient in this current environment, the ability to pick and choose the winners versus the losers, will be a very, very key part of wealth creation going forward.
Interesting. I sort of come to you now, Amit. Future of wealth creation from a strategy perspective. Perhaps you can talk more on the fixed income, the universe that you cater to so well. What would that really be?
So first is to start with the understanding that you don't know. And that has to be very clear. See, the point is that prediction in this kind of environment is becoming increasingly difficult for everybody, whether you are a macroeconomist, whether you are a portfolio manager, or whether you are an investor. So I think the only thing that can save us in the long run is this oft repeated, well, at the cost of repetition, the only two simple words, which is asset allocation and discipline. Honestly, as Bharat, so beautifully put, sleeping with your wrist, the fact is that since most of us don't know how the next 5-10 years will shape up, you have these two as pillars of all the decision makings. One is asset allocation and second is discipline. On top of that, in this kind of an environment, you add two more things here. One is visibility. Prefer something with higher visibility, preferred to something with lower visibility. And second, stay with the winners. So if you actually draw equity market parallels, for example, if the last 10 years have taught us anything, is the fact that the strong become stronger. That's the nature of how the world economy, local economy, companies are shaping up. And that is something that you have to keep at the back of your mind, that when it comes to investments, always are on the side of visibility. Don't experiment too much. Be there where you are comfortable rather than going there where you think you will end up getting 1 or 2% higher returns, but you end up losing money. So if you can combine these two factors of discipline, asset allocation, along with preferred strategies which allow you more visibility and allow you to do something that you are more comfortable with, I think that put together should be a simple strategy or a simple outlook that every investor should employ and every fund manager should employ for that matter. And from the fund management side, that would mean higher and higher levels of discipline in terms of running the portfolio mandates that we run.
Okay. Amit said that, at the cost of repeating the two words, asset allocation and discipline, really at the heart of future of wealth creation. Bharat, I'll come to you and then Sanjeev for sort of the concluding and perhaps the last word being the investor here.
So yeah, so basically, so I just want to add one is in terms of fixed income. Is that fixed income by nature is a asymmetrical risk to your portfolio. What that means is what Sanjeev also mentioned and beautifully explained with his live experiment and his live experience is that what you gain in fixed income is 1 or 2% extra, but if you are wrong, you lose up everything. So nobody is going to give you 2%. Instead of 2%, will say, oh great, Sanjeev, you've done a wonderful job by taking this risk. Let's, rather than 10%, I'll pay you 20%. But he's just going to pay you that 2% extra. But something goes wrong, your entire capital goes away. So I think you should be very mindful when you do a asset allocation or you do any investment in this. So that is a asymmetrical risk, is not evenly distributed. Another important point which I want to say is all about making a right asset allocation, and the framework which I use is called PCA framework. Is called, you should have a right allocation for a preservation of your wealth. You should not hesitate to have a larger allocation to your core portfolio, which should be able to generate you a return which is few percentage point more than a nominal GDP growth. Okay, so if you are able to grow your wealth, a large portion of your wealth higher than a nominal GDP growth by 1 or 2%, you will be able to feel the impact of wealth in your portfolio. And the third is, don't shy away from taking risk, because there is no risk, there is no return. Take risk, but take a measured risk. You understand what risk you are taking, have a smaller allocation but a meaningful allocation which can generate that alpha into your portfolio. And a guy like Sanjeev will pick up maybe a 10-20% stake in some startup. A guy like me and you may pick up a stake in, say, some small cap fund, okay, to get the same thing. It's all about the way you look at. So we are also taking the risk, he's also taking a risk. It's about having a small portion of the portfolio to take that risk with very clear mindset that yes, I am taking that risk, I am ready to lose a large portion of this capital. I know my returns can be 40-50% positive, but I can lose 50-60% of my capital, and I'm taking that risk. So don't shy away from risk. It's all about creating a portfolio which is balanced and provide you a good risk adjusted return to you. And in my parallel, because that is a very important, I say post tax risk adjusted return is what is more meaningful.
Okay. He said that, don't sort of stop taking risks in whatever capacity you have to take risks, because that will ensure return. Sanjeev, sort of, what would be your concluding sort of remarks on the trends defining the future of wealth creation?
So I would probably agree a lot with what has been already said by Amit and Bharat with regard to a key point of asset allocation. Uh, I think that's what creates the return finally for you. I don't think you can try and time the market or time your investment. I think more important and fundamental is get yourself clear, either yourself or through with your investment advisors or the wealth private banking advisors, looking at your profile, what is the asset allocation that you are comfortable with? Stick to that asset allocation. Don't make frequent changes to that, because markets will be volatile. And if you keep on getting nervous with the different changes that keep on happening, you may land up never able to get your return that you would have otherwise got. So I would say, and that's fundamental, probably covered by all of us here, that have a right asset allocation that suits you. Take help for that. Get to see that you don't try to time that, because timing I don't think is easy for the best of people around. And try and stick to that. Don't have frequent changes to that. That's on the larger part. Well, I would also want to say that ultimately, as entrepreneurs, our wealth creation got built with businesses. So I would want to end and add with this: backing good businesses, either at early stage or growth stage, with good managements, can give you the alpha that you're looking for on a long term. And this could be either in the listed space or in the unlisted space. I think that is where you get the biggest alpha for wealth creation.
Entrepreneurial call here, backing right kind of entrepreneurial spirit will be the lever for greatest alpha for wealth creation. Okay, it's time for some rapid fire here, and I'm going to sort of do it a little differently. Sanjeev, my first question to you really is that if you were to do a reverse pitch and really, pitch to these fund managers here two products which you don't see in the market, which you think should be there, what would that really be?
So Shreya, I'll flip the question back. I'm going to say that there are too many products that get offered, too many complexities of things that you got to understand. And I think you got to make simpler products. You actually got to make products that are easily understood by the investors, because there are going to be small investors, also small retail people. You talked about yourself. I mean, if you have to invest something, it's going to be very difficult for you to analyze complex products. I mean, there can be very fancy returns that you see with them. But at the end of it, I believe, and if I have to say something, we need to make simple products which are not difficult to understand. And I think within that framework, it would basically again go to your personal appetite of what you want to select on the subject. So that's my broad thought.
Okay. Amit, you heard from Sanjeev, right? He said make simpler products. Now, if you were to make a pitch to him, convincing him for a simpler product, and I give you an elevator 2-minute pitch, what would that be?
Uh, so Sanjeev, since you have created a lot of wealth here, and I'm presuming that you're looking to deploy that wealth both into preservation and capital enhancement strategies, I have a preservation offer for you where I think we can devise a very, very simple strategy which allows you long term visibility of returns, which allows you peace of mind in terms of the inherent risk that you're taking on your capital, and which also allows you a plan for the long term wherein you don't have to look at the product profile and strategy on a every day, every week, every month basis. So here I am presenting you with a perfect retirement strategy for Nivesh Lakshya. You already are an investor there, and I would always request you to continue being a investor with that product and possibly add allocation and as when you can.
Wow. Sanjeev, I think you're fairly convinced given that you have made huge gains in education anyways. Actually, Amit, pitched his your retirement strategy to you right now over a live webinar, which is
I, I,
fascinating, seriously.
I just want to add to him. I like the option. Just the retirement is a little far away.
So I am planning for the next 25 years for you, sir. So we are cognizant that it's far away.
Okay. Sort of, Amit, you must have received a lot of sort of feedback and, positive appreciation on the roll down strategy, from the Nippon India Mutual Fund. If you were to sort of go back in time, what was really the highest point in your career? What would that really be? Was it really the Nivesh Lakshya roll down, or was it some other product which gave you a like major high?
Yeah, I don't know. I'll take it slightly. So it's not about roll down. It's not about strategy. Honestly, we all are defined by crisis. So the highest point of our careers in hindsight is always defined by what we did when we were faced with a crisis. And to my mind, this was something that I have seen in my formative years, that my worldview, my entire thought process, my entire way of doing things has been shaped by how I, as part of the team in this mutual fund, faced the 2008 crisis. And that will always remain etched in my mind in terms of whatever I approach and whatever I do. So, like I said, if it is an achievement, it has to be on back of a crisis. And that is the biggest achievement that I would always consider as part of my professional career.
Okay. Bharat, I come to you now. One biggest learning that you have had in this crisis.
My biggest learning is we are human beings and we will make mistakes, and we don't know future the way we think, and the things can actually turn around in a different manner altogether. What that means is that you have to first acknowledge that I don't know. Second, you have to acknowledge that since you don't know, you will do a right asset allocation to make sure that irrespective what's happened in the market, you will be comfortable with it. Another important thing is what all of us wants to do is sell high and buy low, and a human tendency and human behavior never allows you to do that particular. And if you can just cross that mental hurdle of buying low and selling higher, I think you have won the half time. And that can be done only on a very small portion of the portfolio, and the larger portion of the portfolio should continue to remain in a core asset allocation.
Okay.
That's my learning.
Yeah, sort of my last question to you, Sokata, is that what has been the most interesting part of today's conversation? Something that you have really taken away or learned?
Everything. I mean, so my biggest, I mean, this has been a learning not just today. I mean, over the last 5 months, we keep talking about 19-20 ka farak. So this is so what a difference a year makes, 2019 versus 2020. So again, I mean, from whatever I've heard, I've learned. I've learned of new products, new strategies. So all of that learning definitely. But I mean, resilience and agility. I think these are the two defining characteristics. I mean, we are entering into a very, I mean, into a many years of uncertainty. Not just COVID. I mean, I mean, the whole business models, things are changing so fast that we have to keep learning. I mean, so this is the basic thing. That even an old guy like me, I mean, I mean, I have to start learning Python. I mean, there's no other way of going about this. So learning, agility, and resilience, I think, are the three characteristics that will define the
That's
investment
sort of
potential
very
for
well
the future.
said. Now it's time for sort of some questions from the audience. There's one question saying that retail investors are increasingly nervous as they're looking at wealth saving in these tough economic times rather than wealth creation. What overlying theory do you advise? I think we sort of already answered this, but maybe Bharat, you want to talk about this because
Yeah.
your
So
asset
if
allocation.
Yeah, so if somebody has already decided that he is looking for a wealth preservation or wealth saving rather than a wealth creation, but I can only tell you one thing. If you are not able to generate a return, okay, in line with, so one, we always talk about a real return, which is return higher than inflation to just preserve the wealth. So wealth preservation is not about not losing money, but to make sure that your money grow higher than the inflation rate. And in the context of a retail investor who's also will have a lot of inspiration, lot of goals and targets in future, he also need to create that additional return, okay, and which that means is that it's getting a too much conservative and getting into an FD or a product which is not even giving you any efficiency at all may not be a right approach. It's like, not, don't go into the shell just because there's too much noise around and I want to waste preservation. There are multiple strategies available. Pick up a product, take a roll down strategy which will give you a predictable return with a higher tax efficiency. Pick up a well diversified good stock portfolio which is futuristic, which that is going to put into the leaders, as mentioned by Sanjeev, is that if you can just get a right companies which are a growth companies and which will be able to generate what Amit mentioned, stay with the leaders. You have seen in last 10 years that leaders are the one which will larger becomes large, the larger become larger. So think like that, right? Whatever we spoke today, most of them basically says that if you really want to be, preserve your wealth, you have to also create some wealth, because if you don't create wealth, your savings will only deplete in terms of the real time.
Okay. Maybe this question is for you, Amit, and say that a lot of funds have roll down strategy. How is one fund different from another? Essentially, talking about the in the debt space. Yeah.
So I think again, at the sake of repetition, since we are using that word again and again here, uh, when you say strategy, what exactly it means is that you are just trying to improve the discipline and the visibility on returns over a period of time. Okay? And the last word is very important here, over a period of time. Ultimately, whenever you're looking at any fixed income product, you marry your time horizon to a suitable time horizon as far as the product is concerned. So, for example, if your time horizon is a 10 years, okay, and you are investing in a product with a 3-year maturity, even though your time horizon is 10 years, you are actually selling yourself short in a sense, right? Similarly, if your time horizon is 1 year, you are looking to deploy temporary money, you can't go and sit in a 10-year fund irrespective of what strategy it employs. So strategy is one part of it. The fact is whether constant duration, whether credit, whether roll down, the most important thing is look at the suitability of the product maturity profile with the investment tenor that you're looking at. So ballpark, and I use this example many times when we talk to our investors, ballpark, your investment horizon has to be at least zero point 0.5 to 0.75 times the duration or the average maturity of the product that you're investing in. So if the average maturity or duration is close to 3 years, you have to invest with a time horizon of at least 2 years. If it is 10 years, you have to invest with a time horizon of at least 5 to 6 years. If it's 25 years, you have to invest with a time horizon of at least 7 to 8 years. So that's how this works. So it's not about one style fits all, because constant duration roll down, they also happen with different time horizons. You have 3 years, you have 10-year variants, you have 25-year variants. So when you're looking at your allocation, be very sure of what time horizon you are looking to invest. Once you're sure of your time horizon, it's very simple to decide which kind of product or which kind of tenor to go and invest in. So decide on your time horizon and then look at the product rather than the other way around.
Okay. There's one question for you, Sanjeev, is that how does one focus on entrepreneurship in these turbulent times?
So it's a old saying, but I'll repeat it, that when the going gets tough, the tough get going. And probably that's where we are today. It's a tough environment. It's a tough situation. I mean, all of us are amongst one of the most unreal events that probably none of us could have ever imagined and thought. And those who are already in entrepreneurship must be facing a lot of stress. Those who are looking forward for or did startups, had some ambitions of moving it faster, maybe finding themselves cash strapped. Good businesses are right now into trouble because world economy is in a very different state. I mean, there is not too much of buying happening. So I think there are several challenges, and I think the only point I would say is that you're not the only one facing it. It's across the globe. It's across every industry, and it is every probably business that is there. Yes, some more, some less. So at this point of time, the only thing you need to do is, if you can preserve and get more cash in terms of whatever you can either raise money, you should try to do that. If you can kind of save yourself from some cost that you are incurring right now, look at that, because you don't know how long you will have to stretch yourself. So that's one important, I think, takeaway right now that all entrepreneurs should look at and see that we are able to tide over this, because those who are able to tide over this are going to become very, very strong and are going to be able to create a much longer impact.
Interesting. So basically, tiding over the tough times is the message coming across. There's one question on, perhaps I think, which we should address, is about this entire gold rush. Is gold the safest investment option right now? I think this is a question which has been asked to us also, from our readers. I think it's a question, it's a relevant question for a panel like this. Amit or Bharat, anybody want to pick this up on, why I'm seeing this gold rush, really from a wealth preservation context? Because India historically has affinity towards investing in gold.
Amit, me or you?
Bharat, you can start, I'll follow.
Okay, done. Great. So what I think I'll go back from where Dada started. Is all about that. It's the way you look at the interest rate, the way you look at the what you can see over a period of next 10-15 years, right? And that's broadly you decide your asset allocation. Why gold rush is purely on three basic pillar. One is we are looking at a close to zero real interest rate or negative real interest rate for a foreseeable future. We don't see any more rate hikes or a situation where we can see any central governments, central banks across the world have an ability to raise interest rate when they are sitting on $22 trillion of balance sheets. So that's first and foremost point. Okay. Second important point is the fact that gold will bring you a sustainable form of storage of value, because if there's so much of money floating around and you are really don't know which economy how they are going to work, there's so much uncertainty around, and if there is a any last hope that there is some can be a case of a very large inflation because of this such a large liquidity around, you need a asset which can preserve value, also diversify away from being dependent on a particular currency or a particular country. So that's a very important point on a $22 trillion balance sheets of the central banks. Okay, if you want to be on safer side, you need to create something which is away from a fancy of it's very loose terms used, but as a whims and fancy of a political party or a political leader and a central banker. Okay, and that's a one particular asset which takes you away from that. And third and most important part is we have seen gold playing a very big role. A gold cycle or the gold price cycle is a very long cycle. For 10, 12 years, you will not see any change in the price of gold. But when price moves, okay, it moves in a very rapid fashion. We have seen last time when the price had this kind of a move, it's actually went up, and I think it was 6.5 times of the price. So if you're looking at a gold from the international point of view, we were stable closer to say $1,100. Today we are at $2,000, and if it's going to be a 5-6 times, you can see where the price of gold can go. And today if you look at broadly what is happening globally, everybody is trying to figure it out that if I'm not going to make money in my fixed income, I'm not going to have an investment opportunity, where do I go and store my value which will give me protection from the volatility of equity market and volatility of the entire uncertainty which I have around with. Amit, if you want to add.
Yeah, so if I were to look at it in a very theoretical construct, how I as a layman would look at it, okay, uh, gold is not a house, right? So it does not serve any purpose in that sense from a utility perspective. So ultimately, you look at gold as a medium of exchange or a store of value. Now, it is in this context, as a medium of exchange and a store of value, that gold gets relatively very attractive in periods of time and not so attractive in other periods. Okay. So, by the way, one thing that I know hardly anything about, but I have seen and read in papers recently that Bitcoin prices, by the way, also started moving up pretty fast. Now, I really don't know whether the thought process is the same, but the thought process is this, that when you have this $22 trillion that Bharat and Saugata have been mentioning about, where you have the risk of debasing of currencies, and you don't have any view on in terms of how this is going to end and which manner our currency is going to shape up, you are looking at a preservation of value and a medium of exchange. Gold is a very accepted asset class that way. Add to the fact that there is uncertainty all around us, not only uncertainty in terms of store of value, but also uncertainty in terms of global growth and inflation. And gold is a global commodity at the end of the day. As and when that uncertainty moves up, especially on the inflation side, people always want to hedge through gold. So you have had a 20-year period of deflation across the world. We are still sitting in deep deflation, but the uncertainties around growth and inflation are perhaps the highest today than you have had at any point in time. And gold is what gives you predictability in terms of a store of value. So you are actually, this entire 1 hour that we spent, we were talking predictability. Gold gives you that predictability as a store of value. And I think that is the moot point why people are getting so excited about this. Not that it does anything extraordinary, but it's trying to do something that other things are not able to do for you today, which is to give you predictability and store of value.
Okay. So not doing anything extraordinary, but perhaps giving you predictability. I think my last question, really, for this panel here, we had this interesting round of rapid fire, the concluding remarks. Also, it was very sort of meaningful. And before we sign off, one key advice to perhaps the investors out there. One sentence from each one of you, just as a conclusion. Amit, want to begin with you?
Yeah, for me, it's very simple. You have to be disciplined as an investor, and you have to reward discipline when it comes to the products that you choose and the funds that you choose. So be disciplined and reward discipline is how I would look at it.
Okay, Sanjeev.
So while times are tough, I don't think the world is ending. We're all getting back quite fast, and I think within some months we are very hopeful that there will be solutions to the current issues of COVID with the vaccines that are being talked about all over the world. So I think there is no need to panic. We need to kind of keep our heads in a cool state and continue where we are. And I think we'll be out of it by 21.
Okay, Bharat.
So do right asset allocation, stay calm and sleep with the risk. There's nothing wrong. You can easily find a level of risk which you can sleep with, and everybody can easily find it. So you just find it and do it, because that's the only way you will be able to preserve and create wealth.
Saugata.
I think we are entering very turbulent but very exciting times. I think there's enormous opportunities for investments that are likely to come about. But as everybody said, I mean, discipline is a very key component in any investment strategy, particularly given the turbulent and exciting times that we see.
Okay, so thank you everybody for giving your time and energy to this. We had a very meaningful discussion. And before we sign off, please do follow all the safety protocols. And here's wishing you goodbye and good luck from Mint. And to all our audiences, thank you for being patient and posing in your questions. And you can also watch this on the Facebook and the YouTube of Live Mint for a lifetime. Thank you so much.
Thank you.
Thank
you.
you.
Thank you for the wonderful.
Thank you.